Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Adobe.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we jump fully into today's topic, we just want to mention a quick resource for you.
Yeah, exactly. So down in the description below, we've got a special 14-day trial link to StockOracle.
Right, which is an AI-aided stock research platform we really like using.
It is. Just a heads up, that is an affiliate link. So the channel may earn a commission if you use it, but that is at absolutely no extra cost to you.
And we always have to say, this StockOracle is a research tool. It is not financial advice.
No, definitely not.
It's not a trading signal service.
Yeah.
And it doesn't give real-time market data. Plus, it uses AI insights and valuation estimates, which frankly can be incomplete or just wrong sometimes.
Yeah, you've always got to verify the important facts yourself. Do your own homework.
Exactly. So check out that link if you're interested.
Okay, so let's get into the hook for today. We're talking about Adobe, and I'm willing to bet you probably have a PDF open on your computer right this second.
Or at least in one of your 20 open browser tabs.
Right. Or maybe you watched a YouTube video this morning. That video was probably cut together and color corrected by a professional editor using their software.
Oh, almost certainly. Adobe's ecosystem is everywhere. You're basically living inside it if you navigate the digital world.
Which is what makes this so weird. Because if you pull up Adobe's stock chart right now, it looks like an absolute disaster.
It really does. I mean, it's brutal.
The stock is down almost 28% year-to-date, trading right around $262.11.
Yeah, Wall Street is treating it like some defunct video rental store or something.
Exactly. But then you look at their actual operations, the business side of things, and they are pulling in record-breaking revenues. So how do we reconcile this?
Well, this is a huge wealth-building context lesson right here. It's one of the most fascinating psychological disconnects in the market today.
Because it's fear versus reality, right?
Yeah, exactly. You're looking at this massive collision between theoretical fear and fundamental reality. Wall Street has built up this whole narrative that artificial intelligence is just going to disrupt legacy software overnight.
Right, like the AI boogeyman is coming for everyone.
Exactly. But when you actually sit down and dig into the fundamentals, you see the undeniable resilience of a corporate monopoly. They're not just rolling over.
Let's talk about that fear for a second, because the narrative driving that 28% drop is all about cheaper AI-first design tools.
You mean like Canva?
Yeah, Canva's the big one everyone talks about. There's this massive anxiety that lightweight, browser-based tools are going to completely cannibalize Adobe's subscription base.
The logic being, like, if a tool is easy and cheap, why would anyone pay for heavy, complex desktop software anymore?
Right, but then you actually look at the financial fundamentals and the numbers tell a completely different story.
The contrast is honestly jarring. You've got a market pricing in a funeral, and the company is over here throwing a parade.
A very well-funded parade.
Seriously. Look at their fiscal Q1 2026 report. They posted a record total revenue of $6.4 billion.
Wow. Wait, in one quarter?
In a single quarter. $6.4 billion. That's a 12% year-over-year increase. And they beat Wall Street's consensus estimates by $120 million.
I just want to pause on that 6.4 billion figure for a second. It's so easy to let these giant numbers just wash over us.
Well, totally.
But that's billions with a B generated in 3 months during a period where everyone is screaming that their business model is dying.
Right. Beating estimates by $120 million is not what a company getting disrupted into oblivion looks like.
No, not at all. And then you look at their earnings per share. Specifically, their non-GAAP EPS came in at $6.06 for the quarter.
And we should probably clarify that term quickly because it does matter. Non-GAAP earnings.
Yeah, go ahead.
Basically, when a company reports non-GAAP, they are stripping out the one-time financial noise.
Like selling a building or something?
Exactly. Real estate sales, weird tax benefits, restructuring costs. Removing all that gives us a much clearer pulse on the actual day-to-day software business.
And at $6.06 per share, that pulse is strong.
Very strong. Strong enough that they actually raised their forward guidance for the fiscal year.
Oh, wow. Really? What are they projecting now?
They're projecting total revenue between $26.5 billion and a $26.6 billion.
That is massive. But honestly, for me, the top-line revenue isn't even the craziest part.
You're going to bring up the margins, aren't you?
I have to. The profitability metrics are just insane. They're operating right now with an 89.4% gross margin.
Yeah, that number just defies gravity.
For anyone listening, just think about what an 89% gross margin actually means in the real world.
Right. It means for every dollar they take in from a subscriber, it only costs them about 10 cents to actually deliver the software.
Exactly. The other 90 cents is completely freed up. They can use it for operating expenses, research and development, pure profit.
And their trailing 12-month net margin is sitting at 28.69%. It's incredible.
It feels like a castle under siege. The market is outside, terrified, the walls are crumbling, but inside, they're just throwing this highly profitable banquet.
Yeah, it's a great analogy.
So how does a company with an 89% margin get punished so badly by the market?
Well, this is what we call a valuation trap, or multiple compression.
Walk me through that.
Sure. So a stock's multiple is basically how much investors are willing to pay today for $1 of a company's future earnings.
Okay, makes sense.
Historically, Adobe has been a huge market darling. Investors happily paid a massive premium for it, but when a new existential threat appears, in this case, generative AI, Wall Street panics.
Right, they shoot first and ask questions later.
Exactly. They aggressively derate the stock, which compresses that multiple. They're essentially saying, we don't care how much cash you're making today. We think you're irrelevant in 3 years, so no more premium.
They're just preemptively assuming those 89% margins are going to vanish.
Yeah, they price in the absolute worst-case scenario. The financial reality of today gets completely overshadowed by the fear of tomorrow.
But that fear totally ignores what's actually happening inside that castle.
Right.
Adobe isn't just sitting there letting startups storm the gates.
No, they are aggressively fortifying the moat. And we really need to acknowledge how deep that moat already is.
Oh yeah, the switching costs are monumental.
Right. I mean, they own the PDF format. That is the ubiquitous industry standard worldwide.
And the Creative Cloud suite too. Photoshop, Illustrator, Premiere Pro.
Yeah.
They aren't just popular tools.
No, they are structurally embedded into the workflows of almost every major agency on Earth.
Think about the mechanics of a real agency. If you run a design firm with 50 professionals, you can't just walk in on Tuesday and say, hey guys, we're canceling Photoshop, we're moving all client files to this cheap browser app.
Oh, the chaos that would cause.
The retraining costs alone would be huge, would halt production. You'd have incompatible file formats, breaking legacy projects. It's a logistical nightmare.
Absolutely. But Adobe also knows they can't rely on just inertia forever. They have to go on the offensive.
Right. And here is where we get into the catalysts. They are aggressively acquiring companies to turn this AI threat into their own weapon.
Yeah, it's a very smart string of M&A, mergers and acquisitions. For example, they bought Topaz Labs.
Oh, right. They do AI video and image enhancement, don't they?
They do incredibly advanced stuff, and they also acquired SEMrush.
Okay, now the SEMrush one confused me at first, because SEMrush is an SEO tool, right? Search engine optimization.
Yeah, it's a powerhouse in brand visibility.
So what does optimizing search keywords have to do with making a graphic in Illustrator?
It comes right back to that workflow lock-in we just talked about. Think about a digital marketer's daily routine.
Yeah.
If you design a web banner in a lightweight tool, say Canva, you still have to export the file, log into an entirely different platform to check your SEO, and run your visibility checks manually.
Oh, I see.
Right. But by integrating SEMrush directly into the Adobe ecosystem, that marketer can design the image and analyze its search performance in the exact same window.
They don't ever have to leave the platform.
Exactly. It's a comprehensive end-to-end solution.
So they are basically buying up the standalone AI weapons that were supposed to destroy them, plugging them into their own software, and selling them back to the users.
It's a brilliant defensive maneuver. And honestly, it transforms an existential threat into a massive monetization vector.
And their internal AI is doing well too, right? What's going on with Firefly?
Firefly is their proprietary generative AI model, and it's crushing it. It contributed roughly $300 million on its own.
$300 million just from the new AI tool.
Yep. And their AI-first annual recurring revenue, the ARR, has tripled over the past year.
Tripled. The tech that Wall Street said would kill Adobe is literally becoming their fastest growing engine.
Exactly. Which brings us to a major pivot point. If the moat holds and they are swallowing the AI threat, the market can't ignore this cash flow forever.
Right, the market has to wake up. So let's talk about the technicals, because the stock chart didn't just stay flat at the bottom. It's been moving.
Yeah, from a technical analysis standpoint, the stock is currently showing a very clear basing pattern.
A basing pattern. For those of us who don't stare at candlestick charts all day, what does that actually mean?
Think of a heavy rubber ball dropping off a roof. It hits the ground, bounces a few times, and eventually settles on the floor, kind of gathering potential energy.
Okay.
A basing pattern is when a stock stops falling, establishes a firm price floor where buyers constantly step in, and builds up energy for the next upward move.
And it's distanced itself from the bottom, right?
Yeah, it had a deeply depressed 52-week low of $190.12. Now it's hovering in the 260s, and the momentum is shifting fast.
It jumped recently, didn't it?
A 14.11% return over just a 5-day stretch.
A 14% jump for a company worth almost $100 billion is a ton of capital flowing in. Where is that money coming from?
It's being driven by a broader macro rotation. For the last year, all the institutional capital was crowded into semiconductor stocks.
Right, the hardware companies building the AI chips.
Exactly. But recently, investors have been taking profits from those hardware names. And that money has to go somewhere.
So it flows out of semis and rotates into lagging enterprise software names like Adobe.
You got it.
That makes perfect sense mechanically. The big money made billions on the picks and shovels, and now they're buying the software companies that will actually sell the finished AI features to the consumer.
Especially the ones trading at a massive discount.
Which Adobe definitely is.
Yeah.
Let's look at the sentiment and valuation because it feels almost broken.
The multiple is just wildly low.
Right, the trailing price-to-earnings ratio, the PE, is at 13.7.
Which is incredibly rare.
Just to contextualize that, you have a tech giant with a near monopoly, growing revenue at 11.49%, trading at 13.7 times earnings. Usually software companies with this kind of moat trade at 30, 40, maybe 50 times earnings.
Seeing an incumbent with an 89% gross margin in the low teens totally validates that the market priced in an apocalypse.
But the people inside the company know the apocalypse isn't coming.
Okay.
Let's talk about the smart money, the insiders.
Oh, this is the best part. Over a recent 90-day period, we saw net insider buying of nearly 130,000 shares.
130,000 shares.
Spread across 36 distinct buy transactions compared to just 61 sells.
I always pay way more attention to insider buying than selling. Executives sell stock for a million boring reasons, right?
Oh, for sure. Buying a house, paying for college, diversifying.
We actually saw that recently with Adobe's president, David Wadhwani. He sold 1,498 shares.
But the filing showed that was explicitly for tax withholding purposes related to his stock vesting.
Exactly. It's just administrative housekeeping. It wasn't him making a bearish bet against his own company.
Right.
But the golden rule is executives only buy stock with their own money for one reason. They think the price is going up.
Exactly. When you see cluster buying from insiders at these deeply depressed valuations, it is one of the strongest technical confirmations of undervaluation in the whole market.
They see the internal dashboards. They know how well the AI tools are retaining customers.
Yep. They see the 13.7 PE, and they are backing up the truck.
Okay, so the foundation is solid. The stock is breaking out of its base. Insiders are buying. Revenues are at record highs. But let's balance this out. We got to talk about the risks, the bear case.
Absolutely. We have to look at both sides.
Because even with the moat, if the market is punishing them this much, there has to be a tangible fear that things could go wrong. What happens if Canva and these other tools do start stealing massive market share?
Well, that's the core bear case. The risk is that AI fundamentally lowers the barrier to entry for design.
Meaning you don't need to be a Photoshop expert to make something that looks professional anymore.
Exactly. If you can just type a text prompt into a browser and get a perfect image, suddenly that heavy, expensive desktop software becomes a lot less necessary for a huge chunk of the market.
And if those users start churning, leaving the ecosystem, that 89% gross margin could start to compress really fast.
Right. And if Firefly doesn't actually retain users long-term, if it's just a novelty, then Adobe's growth stalls. And if growth stalls, that premium valuation Wall Street used to give them, it's never coming back.
So the real risk is that the market's fear is actually just a sneak peek of the future, that the moat is drying up.
Precisely. If the AI integrations don't stick, or if the M&A strategy with SEMrush fails to keep people locked in, the stock could stay trapped at this multiple.
Okay, that's a very fair warning. But what about the upside catalysts? Are there any upcoming events that could swing the momentum the other way?
Definitely. The overarching mood among analysts is already pivoting. It's moving from pure fear to, cautious optimism.
Any specific analyst ratings?
Yeah, Mark Murphy from JP Morgan recently maintained an overweight rating on the stock.
Which is Wall Street speak for a buy rating.
Right, and he put a $420 price target on it. From where it's trading now, that's a 67.5% upside.
Did he say why?
He pointed to their incremental AI monetization and what he called their elite profitability structure.
Elite profitability structure. That is such a polite way of saying it cost them a dime to make a dollar.
Very polite.
In terms of actual events, though, what should we be watching?
September 2026 earnings. That's the big one.
What are people looking for in that report?
The focus will be entirely on that AI ARR. Wall Street needs to see if Adobe can sustain triple-digit growth there.
They need to prove Firefly is a core driver, not a novelty.
Exactly. Plus, there's some pretty wild rumors swirling around, too. Speculative, but interesting.
Oh yeah, I saw chatter about them potentially integrating Claude AI
Yeah.
into their workflows.
Yes. And even bigger, there's a rumor of a potential open secure AI alliance with NVIDIA and CrowdStrike.
Now that would be massive. Because if you're a Fortune 500 company, you're terrified of employees leaking data into open source AI.
Right. But if Adobe teams up with NVIDIA for hardware and CrowdStrike for security, they create this secure, closed-loop AI environment. Enterprises would pay a massive premium for that safety.
But let me push back a bit. Is relying on rumors like that dangerous for an investment thesis?
Oh, absolutely. Building a thesis on unconfirmed rumors is a terrible idea.
Okay.
But the strength of the Adobe thesis is that it doesn't need that alliance to happen. The core thesis is grounded in 12% revenue growth, a 13.7 PE ratio, and heavy insider buying. The rumors are just potential icing on a discounted cake.
So we've covered the fundamentals, the technicals, the sentiment, and the bear case. What is the final verdict here?
Well, based on everything, Adobe earns a highly bullish score of 8 out of 10.
An 8 out of 10.
Yeah. This isn't some speculative day trade. It represents a multi-year view. The massive cash flow heavily protects your downside, while the upside is tied to the market finally waking up and re-rating the stock.
It's an asymmetric setup, but remember, we aren't telling you to buy, sell, or hold this stock.
Right, we're just analyzing the setup. The data suggests the market panic doesn't match the corporate reality.
Which is exactly why you've got to look under the hood when Wall Street panics.
Always. The reality is usually much more profitable than the headline fear.
I want to leave you with one final thought today. We spend so much energy looking for the next obscure AI startup in a garage that's going to change the world.
We really do.
But what if the true winners of the AI age aren't the startups? What if the real winners are these legacy monopolies, the giants who have billions in free cash flow to just buy the best AI tech and plug it directly into millions of users who are already too locked in to leave?
It's a great question.
You've really got to ask yourself in the long run, will pure innovation win out? Or will massive established distribution ultimately beat innovation every single time?
Something to think about for sure.
Definitely. All right, that is going to wrap it up for today. Don't forget to check out the description below for that special 14-day trial link to StockOracle.
Yep, check it out if you want to dig deeper into the data yourself.
And as always, if you find our talks useful, please consider subscribe, like, and comment underneath. We will see you next time.